Hello, everybody. This is Rick Geiler with Silverside Insurance here in Arizona. I have on the line with me Tony Filarillo. He is the president and founder of Asset Management Strategies in Indianapolis. Can you hear me, Tony?
I can hear you fine. Good afternoon, Rick.
Okay, great. Hey, thanks for being with me here. The main focus today is going to be the market update based on some of the recent market turmoil triggered by the Brexit, the UK leaving the European Union last week. We've seen a lot of volatility since, and this gives us a good opportunity to get Tony's insight on how AMS approaches market volatility and conditions such as this to protect downside risk without possibly missing too many opportunities that might be presented. So I'm going to get this over to Tony in a minute, but there may be a few of you online here who haven't been on any of our past webinars or who haven't listened to our podcasts that highlight the program, the partnership between AMS and Silverside. So I'm going to touch on that real quick. Please notice in the bottom right of your screen, and it may depend a little bit on how your go-to is configured on whatever platform you're running it on, but there are 3 handouts today that are going to help describe how this program works. You're going to see the AMS's most recent global strategy. That's their monthly update. That's from the end of May. That shows some of the results and some of the actually that's something I should let Tony tell you a little bit more about because he's the one who puts it together. But it's the monthly summary from AMS. Also, I have a sample of the solicitor arrangement, the solicitation agreement, which would allow agents such as yourselves to offer AMS services on a solicitation agreement. I'll touch a little bit here in a second on exactly how that works. And then there is an FAQ sheet, frequently asked questions, that we've been getting on how the arrangement between AMS and Silverside works, and thus how the arrangement between AMS and you as an agent will work. So I'll touch on this real quickly. What we have here is an exclusive arrangement offered to you agents, and it's from a partnership between Silverside and AMS. Silverside is a fixed annuity and life insurance marketing firm. We don't do variable business. We're not broker-dealer affiliated. We do solely fixed products. So what we're talking about is an exclusive arrangement to agents offered by the partnership between Silverside and AMS. AMS will provide the money management. We can clarify exactly what that means here in a second. Fixed products and support are through Silverside. So the AMS arrangement, the solicitation agreement, allows agents to offer fee-based asset management with or without a securities license. You don't necessarily need a securities license to participate. You will be able to collect an ongoing referral fee. AMS will share a portion of their money management fee with the soliciting agent as compensation for maintaining the relationship with the end users. And what this is going to help you with, there's a lot of compliance concerns coming up from new Department of Labor rules, how that's going to affect source of funds, how you are going to be able to manage your fixed business based on advice on variable and money management monies. So this is a quick way for agents who are not interested in getting or continuing to operate under their own securities license to offer AMS's money management services. And then the fixed business, Silverside helps you with that. We have a wide offering of products, carriers. We do trainings and updates. We can do comparisons. We have an income design and a life case design help desk. And we have agent marketing, branding support. We have a number of things. And I know I'm moving pretty quick here. I wanted to just touch on how the program works. Please go ahead. If you haven't listened to the podcast, or you should have gotten a link when you registered today, or you'll get a link as a follow-up. If for some reason you're not clear on how this program works, go ahead, either listen to the podcast, give us a call at the office. We can help clarify that for you. So with that, I kind of want to move on here and see as a market update. Let's move on to that portion of this. One thing we've seen immediate impact on in the fixed business rates. We're looking at a 10-year bond chart here. A chart, it's actually going back about 70 years on the 10-year bond, which is a traded commodity in Chicago, but it's highly indicative of current interest rates. And as we can see here, we're hitting basically an all-time low, right under 1.5% is what a 10-year bond is going to get you. And we see immediate impact. We've already seen some of the fixed carriers reduce MIGA rates, multi-year guarantee annuity rates, have dropped already just over the weekend, apparently in response to the market knee-jerk off of the UK situation. So now more than ever, it's important to keep shopping for rates, shopping for carriers, keeping tabs on those things. So that's something at Silverside we can help you do as it pertains to your fixed business. And now I'm going to get it over to Tony, and he is going to be our market expert, and he's going to give us some of the insights on how he sees the market conditions and some of the approach AMS takes to minimize risk and downside while continuing with some upside opportunities.
Okay, well, Rick, thanks again for having me on. I appreciate the opportunity to talk to the group. Yeah, quite a bit going on the last couple of days. Lots of drama in the world marketplace, that's for sure. But I think at times like this, we want to, just kind of do a broad overview of what happened, how bad it was, maybe bring some perspective to it, and then also look at how much worse it might get or not get, and then, look at how our model performed, in the face of this, and give you some ideas of how the model works, what the limitations are, what the advantages are, and then maybe some talking points to move forward, what to say to your clients, how to address this with your clients. So first of all, this chart is just a one-year S&P 500 chart. To bring some perspective to this, last week, the market was down dramatically on Friday after the British voted to exit the EU. For the week, people forget that we had two very good positive days earlier in the week, which I think the market was up. The Dow was up about 350 points on 2 days, and then it was down over 600 on Friday. So if you look at the full week, just the 5 days of trading, a lot of people are surprised to see that the S&P was down 1.6% in those 5 days, which is not necessarily what we call a dramatic bear market. So I think that's helpful to bring some perspective. If we look at where the market is right now, where we're seeing a pretty significant rally back here today, counting today's rebound, the S&P is down less than 1% year to date. So what we've done basically is we had run up some fairly nice gains, after the 10% sell-off from January into February. Then the market came back, erased those losses, had some pretty decent gains, a couple percent on the plus side, and now it's given all that back again. So it's kind of a starting over point. So, I don't really want to go into the politics of what happened, and I think everybody has seen that ad nauseum. What that means. I think that the most interesting thing for us here in the United States is that it does seem to be a mirror of our sentiment here, that they don't care if this is a good move, this is a bad move. It's just something different. And I think if you look at our presidential election, we're seeing the same type of sentiment here in the United States. So, will this get worse? Will it get better? First of all, we probably won't know the answer to that for 2 years. What we will know quicker than 2 years is as this thing rolls out, as it gets implemented, as the separation or ultimately divorce really takes effect. We won't see the impact of that in Great Britain. We won't see the impact of overall in Europe. We won't see the global market impacts for quite some time. So right now, all of this is speculation of what this might mean. And I think that, because of that, what we've seen is a lot of drama that probably could have been a lot less than what it was. I think there are three things that could make this worse. One is contagion. If you see this as the first of a series of dominoes, much like the fear was a couple years ago with Greece and their defaulting on their debt, would they be the first of a number of those countries that would follow suit? If France, elects to get out, certainly if Germany elects to get out, we've got a big problem. And, right now you've got 28 members down from 29 members that had a pretty diversified pool of economies. You had the stronger economies and the more responsible fiscal players that were propping up the weaker economies. And I can't say that I blame Britain for finally saying, if they are one of the stronger players, finally getting to the point where they're tired of paying the bills for the people that aren't acting responsibly. And those would be namely Greece, Portugal, Italy, Spain, that are the most challenged. So we'll see what happens there. But I think the contagion is a critical factor. If that gets worse, then I think this situation could get worse, and the markets could react to that. The other thing that is a negative because of this is that the dollar has gotten significantly stronger. When the dollar gets stronger, it's harder for the U.S. companies to increase their exports. So that is a challenge and a negative to U.S. markets. And I think the third thing is the risk that because the dollar is getting stronger, that now China will devalue the yuan again. And if they continue to manipulate their currency as they have proven that they're willing to do in the past, that can be detrimental to U.S. exports and so forth. So I think the other thing that's interesting in all of this is, once again, we've got a worldwide crisis. We had Greece, we had Cyprus, we had, pick a number. Every time this happens, we see the same result. And that result is people buy treasuries and they buy the U.S. dollar. So even though we may criticize our economy, we may criticize our political system, we may criticize the health of our S&P 500 companies, we are the tallest midget. And anytime that there is risk and there is uncertainty, which is certainly the net result of what's happened with this exit vote, people rush to the United States, they rush to dollars, and they rush to U.S. treasuries. And that's why we see the treasury values driven up so high where the yields have been run down so low. So, of course, all of this is tiptoeing around, the elephant in the living room that we don't talk about, which is the world debt level. And the world debt level currently is at 286% of world GDP. And that's a number that we have never seen before in the history of the world. So at some point, the music will stop. And I don't know when. It could be 6 months. It could be 6 years. It could be 60 years. We don't know when that will happen. There are some economists that think that we can grow our way out of this mess. I think that's a very, very outside challenge that is very unlikely to happen without some type of responsible austerity programs and spending and that sort of thing. But, as it stands right now, we have the highest level of debt to asset ratio that we've ever had. Now, just because we owe that money doesn't mean that it's all going to be coming due shortly. Some critics of the market valuations think that that's going to happen rather abruptly. I don't think that that's the case. I think if it does come to fruition, that it will be more of a slower, gradual type process that would pick up momentum as it started. But nothing that's going to happen in one single day in the trading, that's for sure. So, if you look at 2008, much like the run-up in valuations up to 2008, there was a considerable amount of money to be made right up until the point where the credit default swap and the real estate markets crashed. And there were an awful lot of people that called that right, but they called it too early and they went broke waiting for it to happen. So I think that's a good lesson in what this could be. I don't know that we're at that point. I don't know that this is the critical inflection point that is, the first sign of the financial apocalypse. Don't know that. And fortunately for our software, we don't have to know that. All of the conversations of what will happen with the markets are really more of a fundamental argument of what this will mean or what it won't mean how it will be perceived when the information comes out into the marketplace. And what our software looks at is the tactical or trend following process, which only looks at price movement. And once the price moves, we know definitively what's happening. If the price is going down, that means that there's more sellers in the marketplace than there are buyers. If the price is going up, it means there's more buyers than sellers. We don't have to know what the reason was, what the rationale was, what the sentiment was. We know the net bottom line without argument. You know, you could, in this case, it's pretty clear that the catalyst for this was the British exit. So, you know, in this case, it's a direct correlation between cause and effect. But a lot of times it's not so clear. And I think that, you know, looking back, stepping back and looking at the market in perspective shows, you know, a little bit of the forest for the trees, if you will. So if you look at where our model is, which is the, you know, the equity model. Before I leave this chart, the S&P, though, there's a couple of things I wanted to show you. This goes back 1 year. And a year ago, we had a pretty dramatic sell-off in the S&P 500 and the markets back in late in July and into August. Our model went to cash at this period, so we did not have the drawdown in the marketplace last August. I'd like to say that we got in right here at the absolute bottoms, but we didn't. And we didn't get in until the market had pretty well repaired itself. So all we missed was a lot of drama. You know, nobody opened the statement, so their account value was down 10%. That happened again this year in January. The first week in January, we went to cash again. We didn't get back into the market until the markets had bottomed out and recovered pretty substantially. So again, we didn't pick up 100% of this upswing in the market, but all we missed was all of the heartache. And I'm okay with that. So going into the end of May, our model was about just under 50% in the S&P, or 50% invested. And I'll show you this as if you look at our fact sheet on the second page, it shows the two holdings that we had, which was small cap and the S&P 500. Fortunately, we didn't have any international. We didn't have any emerging markets, which were the two parts of the global markets that were hit the worst. We had just under 25% allocation to the two of those. So to give you some perspective, and this is going to be a little bit different because we did have a small cap allocation, but last week when the S&P 500 was down 1.6%, that means that our model was down probably about 0.8% for the week. And that shouldn't be enough to derail people from their long-term plans. So we're happy that we had limited exposure. We're extremely happy that we had zero exposure to the international markets. The nice thing about that is with our model, we don't have to be good predictors of what's going to happen. We don't have to know if the worst is over for this sell-off, if the worst is over for the internationals, if the worst is over for the emerging markets. If that's the case, those markets will start to move upward. When that happens, the software will identify that and give us buy signals back into those areas. So right now, we're okay if those markets are in a free fall because we're not there. And if this market continues to go down, our domestic market this week doesn't hold these gains today and stay in pretty good shape, we may get sells later at the end of this week. And I'm okay with that. You know, I think what our model looks at is it looks at two situations where we want to be out of the market. It looks at occasions where it sees an acceleration into the downside, and it will also have us out of the market when it sees very little promise for the upsides. And we're not there yet. We're still holding at just about 50% allocation, but it's all domestic. Mm-hmm. So I think the talking points that we could take away from this are to capitalize on the fear of, what happened in the turmoil in the markets. You could be out talking to your clients about, what's your exit strategy? What is your level that will scare you? What headline is bad enough to make you say enough is enough? And what we do with this model is we take care of that discipline for them. They don't have to make that decision. And a lot of times I think we bring some logical, rational, bigger picture perspective to it. so we don't overreact to short-term noise. This is a little bit more than just noise. I mean, this is a substantial event. This is a substantial move in the markets. I don't know if this is the beginning of a much, much bigger sell-off, or if this is the worst is over and we've seen the worst yesterday, and now the markets are going to start moving straight back up. Don't know that. And what I like about this model is we don't have to know that. You know, we will let the price movement dictate where we will take the allocations. Now, the disadvantage of that is it's not predictive. You know, had we been 100% invested last week, we would have taken it on the chin just like every other model. But if that's the case, at least rest assured that we won't perpetually sit on our hands and do nothing. Is not as clean-cut an example from the British exit last week, but I think it was 5 years ago we had the tsunami in Japan. The market started to say, maybe this isn't as bad as what we initially thought. And the markets repaired, and on Thursday and Friday of that week, the markets were up pretty dramatically. So our software, which looks at Friday to Friday closes, would have looked at the close from one Friday to the next, including the week of the Japanese tsunami, and said, nothing happened. And that's exactly what we wanted to do. We don't want it to react to that, day in and day out for a weekly period. We want it to be working in the background to protect us from catastrophic losses. And loss of less than 1% in our portfolio for a week is not what we consider to be a catastrophic loss. Mm-hmm. And as the market is down less than 1% year to date, that's not necessarily a market that we want to be afraid of and be out of. But if this sell-off gets worse, which we won't know until it happens, our model will act. So that's where we stand today. I think that, I think this is a good opportunity for people to talk to their clients about, what would you do? What have you done? Did you get a call from your broker? Was there a change made in your portfolio? And most likely, the answer is going to be no and no. They didn't get a call unless they called their broker. And if they did talk to their broker, the broker said, you're in it for the long haul, stay put. This is just a rough patch. We'll get through this. Everything will be fine. And maybe it will. But I like to have more of a discipline, more of a function working in the background that will dictate that to us rather than have us at the mercy of the markets. So that's really all I have, Rick. I just wanted to kind of give everybody an update on, what the markets did in the last couple of days, and more importantly, what our models did in the last couple of days, just to give them an update.
Right. And I know a lot of the guys out there, like me, are predominantly fixed guys. We do work with clients, or we do talk to people about variables and about the markets, the outright markets, not the index filter of the markets. So any talking points you have that can help agents? I know you've given us a couple, prompting the questions, what would your exit strategy be, those kind of things. But how else can AMS help agents convert their clients into this money management platform? I know you work one-on-one with a lot of agents. You even work one-on-one with them, with their clients once they get them interested. Any more talking points or anything along those lines that we can give here in a nutshell today to help guys out?
Yeah, I think one thing I would point out, and we've had this conversation with a number of agents in the last couple of weeks, I think people are surprised to learn that a lot of brokerage and advisory clients work under just a non-discretionary capability. What that means is that the broker or advisor does not have discretion to go in and make changes in the client's account without the explicit permission from the client. And what we have is a discretionary account. What they have is a non-discretionary account, meaning that they have to get permission from the client. So I say that backwards, I apologize. So our discretionary account, which some regulators have said is not necessarily discretion because we don't buy and sell anything. We only buy and sell these defined major asset class exchange traded funds that are what we use in this model. And the clients give us permission to buy and sell those assets. Some regulators don't think that what we do is discretion. We're going to err on the side of caution and have that discretionary management agreement anyway. But the way that works in the real world is if your broker advisor, even if they wanted to make a change in their clients' accounts, they'd have to call those clients and get the permission to do it, or their compliance department would show them the door the next day. So they can't just arbitrarily go into their clients' accounts and say, this is bad, this is getting worse, I'm afraid for our financial lives, and I'm hitting the panic button. Right. They can't do that. And I think a lot of clients are really misunderstanding that the broker or advisor, because they don't have that capability of having discretion on the account, that they can't do that, even in the worst case scenarios. So what's that mean? If you're a successful broker or advisor in this business, you may have 2,000, 3,000 accounts. Where does your client get that call? Even if the broker does want to start calling all those people and recommending that they sell assets in their accounts and protect themselves from, horrific market declines even further than what we've seen. When do they get around to calling each one of those clients? And the answer is probably not soon enough. Right. So what our model does, and I think a great advantage that we have, is that it's a very unemotional, it's a very logical, very disciplined approach. The software runs every weekend, and if we get buys or we get sells, we go into every single account and we make those buys and sells across the board, literally with the push of one button. And I think that that's a very comforting factor for a lot of investors, that they don't have to make a decision, number one. They don't have to rely on their own capabilities in making that decision. Number two, they don't have to rely on their broker or advisor to get around to communicating that, even if the broker or advisor does feel like this is the time to sell out, which many of them will never tell you to do that from a compliance standpoint. And number three, even if they do make an emotional decision to sell out, then they've got to make a tough decision of when to get back in. And that can be just as important as the decision to get back to when you get out. So, I like to have this discipline working, and I like to have it in somebody else's hands so that they don't have to worry about, hey, I didn't get the phone call, or I missed the phone call. I've got to stay home today because I'm wondering if my broker's going to be calling me to recommend sells. We don't work that way. If it's bad and it's getting worse, we're getting out. And we're going to do that unilaterally across every account.
Okay, great. Well, thanks for that, Tony. I see we're running a little over half an hour here, so we're going to get wrapped up. I want to point out to everybody again, we have the handouts today that are going to give a little more on how the program works, the frequently asked questions, and the global strategy sheet you're looking at now. And go ahead and get a hold of us if you have more questions on the program, or if you want to get involved, if you're not already involved, and you want to have a consultation appointment with Tony, we'll get you set up there. He can answer any specifics you have on how the program works, how you might approach your clients, at what point you might get Tony involved discussing how AMS works with your clients. All of the above. We should have the podcast link that highlights exactly how the program works as far as percentages and whatnot, and a lot of that I think is covered in the FAQs. So if there's anything left that we didn't get to, I don't have any questions right here. I do have a couple of people asking about specifics about licenses and state availability. We're broadly available in every state at the moment. Is that correct, Tony?
That's correct. Yeah, there are some states that have some notification regulations that we have to tell them if we're working under a solicitation agreement, but it's state by state, and the vast majority of states don't have any requirements like that at all. So the solicitation agreement is just a very clean, straightforward process where we can share revenue with people even without a securities license, which a lot of people are surprised at. And I think that, the broker-dealer side of the business can't do solicitation agreements. The only way that broker-dealers can share revenue with anybody is if everybody is fully securities licensed. So the broker-dealer community is certainly not going to spread the message about solicitation agreements. That leaves it up to the registered investment advisory community. Is an established white glove type of firm, and they get plenty of new business just from referrals. Quite frankly, my business gets, very good growth just from internal referrals. So, I'm like most other firms where we don't necessarily have to have an auxiliary marketing function. We're interested in growing and working nationwide, partly because we've had some experience with working with clients throughout the country already. I'd say probably half of our clients have never been in my office in Indianapolis. So in that sense, we do function somewhat as a robo-advisor. But I do think we're different than robo-advisors in the sense that we have a personal connection with each client. You're not one of 10,000 per service representative like some of the robo-advisors are. And the other thing I think that is critically important in the robo-advisor concept is performance. You won't see a lot of the firms talking about performance other than just kind of models and different allocations. And, had you been allocated this way, then that's the best way to move forward. We do have a documented track record for 13 years, and it shows the overall performance at about 1.7% over the S&P with roughly half the risk of the equity markets. So, that I think pretty much wraps it up.
Okay. Well, I know we had a couple other questions, license specifics and things, but we can get to you one-on-one if we didn't get to any of your questions, or if you have some you didn't ask, or you want to go ahead and have a consultation with Tony about getting signed up as a solicitor yourself, or about approaching some clients you might have, and how he can help you do that, go ahead and give us a buzz at 480-998-1286, and we'll get you taken care of. So with that, we'll wrap it up. Thanks for being with me today, Tony, and thanks to all you attendees.
My pleasure. Thanks, Rick.